Hi everyone, welcome back to my channel Ask Parul. So India's alternative investment fund, commonly known as AIF industry, is growing at a staggering pace, and Gift City is opening up massive opportunities, especially for NRIs. But what does this mean for you? To break it all down, I have my esteemed guest, Mr. Akhil Chaturvedi. He is the Executive Director and Chief Business Officer at Motilal Oswal Asset Management, with more than 25 years of experience in the Indian financial services. We'll also be covering questions from the last video. And if you do have more questions, drop them in the comments. We might answer them now or in part two. Mr. Akhil, welcome to my channel.
Thank you so much, Parul. Thank you.
Great. So, Mr. Akhil, I'll just jump right into this discussion. And I was reading some of the stats about India's Gift City and AIF, which is a byproduct, I believe, of Gift City, commonly known as Alternative Investment Fund. Let's just start with the basics. What exactly are AIFs? What does it stand? What are the different types that exist in India? And how are they different from the traditional mutual funds? If you can just enlighten our viewers, let's start with the basics first.
Yes, Parul. So you're right that AIFs over the last 12 odd years have grown over 20% compounded year on year. In fact, the number, if I have to update, is not 8 lakh crores now. This number
Okay.
is 12 lakh crores.
Okay.
So year on year, I think this particular vehicle is growing at a very fast pace. Now, traditionally, as you rightly said, the conventional most efficient vehicle for investors to participate in the Indian capital markets used to be mutual funds. Through mutual funds, you could buy equity products, you could buy fixed income products, so on and so forth. Alongside our regulator, which is SEBI in this case, also gave the portfolio management service license. Now, this particular vehicle, so mutual fund is one vehicle, then portfolio management services is the another vehicle, which came in somewhere in the mid 90s. Portfolio management services were basically targeted towards slightly evolved clients. Ultra HNI is what we call them. People who are more, risk averse. They understand financial products. They could take some, they could invest into focused portfolios, niche boutique portfolios. So that's when the whole evolution of alternate ideas actually started. Now,
Hmm.
somewhere in 2012 is where the regulator also came out with the license, which is the AIF license, which is alternate investment funds. This was essentially to streamline regulation for investors who are investing into private equity or angel investing through alternate, the early age businesses. A lot of fixed income products also was actually out of the regulator ambit, right? So to bring all of these non-equity products as well as equity products into a proper regulatory framework, AIFs took birth. Now, again, broadly in AIF, there is a lot of flexibility which is given by the regulator in terms of how you create your portfolio, your stock level limits, your sector level limits. Apart from that, there are three broad categories for AIFs. There is a category one, there is a category two, there is a category three. Now, category one is for those fund managers who want to launch funds which are early stage funds, what we call as venture capital funds, or basically investing into companies which are very, very, very young, right? Startup kind of businesses. So that's the Cat one. So anybody who wants to launch a venture capital fund has to take a Cat one license and then launch their products. Category two is actually the largest category, which is almost, I would say, almost 70% of the 12 lakh crores I spoke. So 8 lakh crores is the category two. And category two is all about private equity funds, real estate funds, and fixed income products. So these three
Hmm.
asset classes go under the category two. And then the third category, which is category three, is for listed products. So if you want to launch products which are actually investing into the listed stocks, or alternatively, you want to do certain derivative strategies like long short funds or absolute return funds, all of these can be bucketed into Cat 3. So Cat 1, Cat 2, Cat 3.
Okay.
Now, all kind of funds, whether it is venture capital to private equity to real estate to private credit to listed to long shots. Everything is now well regulated under this whole gambit of AIFs, right? And it's a pretty clean structure, simple to execute, good for the fund managers because it's a pooled vehicle, easy to manage the portfolios. The accounting is easy. The taxation also is slightly different for Cat 1, Cat 2, and different for Cat 3, but fairly easy to understand for investors, right? So just kind of streamlined some of the nitty-gritties which was difficult to manage on the PMS side. So for the retail investors, mutual funds make good sense. But for high net worth investors or ultra HNIs, family offices, AIFs is becoming a very attractive vehicle to really invest. Obviously, the minimum
Right.
investment amounts are very different. So for mutual funds, you can start with as small as 500 rupees through the SIP route. But for AIFs, the minimum investment amount is 1 crore. Unless you are an accredited investor, then the limits actually fall down to maybe 25 lakhs or so. So in nutshell, this is all what AIFs is all about.
Right. And I feel couple of follow-up questions. So AIF, I believe, is one of the products under Gift City, right? Correct me if I'm wrong, right? So
Yes,
it is one, correct. And you also mentioned that it's for HNIs, high net worth individuals, and there is a limit of 1 crore. I believe, is it 150,000
$150,000.
USD?
Yes,
It's
yes, yes.
150,000 USD.
Yeah.
So it's basically like rich people mutual funds,
Actually,
sometimes.
yeah, I'll actually let me clarify. Now, in the Gift City, what is happening now? Gift City is another initiative by the government
Yeah.
to promote, kind of create a global access for Indians to, take exposure out of India. So there could be funds which could be created here by foreign asset managers into the Gift City, and Indians can then invest using the LRS route into, let's say, China or US, or fixed income products outside of India. So you can do the asset allocation. But more than that, I think the inbound part is making a lot of sense. So for the NRIs and the FPIs or the FIs who want to come into India with their dollar investments can actually participate into the Indian capital markets through Gift City. So that is the kind of initiative basically to attract global investors into the Gift City, which is basically Gujarat International FinTech City, which is like
Mm,
housed within the India. It's a special economic zone where within India, it's a offshore location where one can transact in international currencies. Essentially, it is US dollars, right? So that's how this whole thing kind of took birth. But in the last 3 or 4 years, it's really gaining a lot of traction. One, of course, India has been doing extremely well, right? So the Indian markets have been doing very well. Broadly, the rupee was pretty stable. And let's keep the last 2 months away. But generally, we've been a very stable macro economy and very, very strong and buoyant capital markets. So we ended up attracting a lot of NRIs through the Gift City vehicle. I mean, rather than going to Mauritius or some of the other
right.
geographies, why not we actually utilize something which is easily available in India itself, right? Now, what the regulator, so in India, the regulator is SEBI for capital markets. In Gift City, the regulator is IFSC. Now, what they're doing is basically that they have taken learnings from the Indian capital market or SEBI, and they've just tried to, or they're trying to replicate same model on the Gift City platform. The only difference is basically in India you invest in INR and in Gift City you invest in dollars, right? Now there are variety
Mm,
of licenses which are available in Gift City. So I can decide to at some stage start my own mutual fund over there. So I can have a mutual fund for retail investors based out of Gift City. So I can get that license actually. I can get a portfolio management service license also, and I can get the alternate investment fund. So all that what is available in India is also possible to launch in Gift City. Now the question would be that why don't you actually go for that? Or within the AIF, you can
mm,
actually go for a, I mean, we have an institution license, but you can go for a retail license where you can take smaller denominations. Now, since this
okay.
is early start, it's just like 2 or 3 years. There were teething issues. We were also trying to understand regulations. I'm sure some of my
Mm,
industry friends also would be trying to do that. So I think the starting point has been for most of us to first experiment with the institution license. where the minimum investment is like $150,000 and more.
Mm.
But I think as it will evolve and as we get comfortable with the regulations, some of the other nuances of the vehicle, I think at some stage, in AMCs will evaluate, probably taking a retail license or starting their portfolio management service or even mutual funds, right? So all of these things which are
Mm.
available in India, just wanted to clarify, is also available in Gift City. For now, most players have chosen to go through the institution route, but I think somewhere down the line, we will create access for retail investors as well.
So currently, people like myself, I'm a retail investor, or maybe the audience who is watching, can they still access things like Gift City and AIFs?
Yes, you can access, but as I said, that at
Okay.
this stage, since we have an institution license, or most of the asset managers have an institution license, therefore the minimum ticket size is on the higher side, which is $150,000.
Correct.
Maybe for the NRIs, it may not be that high, but
No, it's still a big amount.
but yeah, so it's there. But there are these platforms which are there's one which we
Right.
are dealing with. It's called Crystal Platform, where you can open an account on the platform, and the platform can give you lower denomination. So those options are available, but let's keep it simple. Yes, for now
Right.
you can participate, but the minimum is yes, 150,000 for now.
150,000 US dollar, right?
US
Okay.
dollars. Yes, yes.
Right. So I'm quite curious now. So you mentioned few things, right? So you mentioned 150,000, it's for retail investors. Now, let's assume I'm an NRI, or let's say somebody who's watching is an NRI. What are the key advantages as compared to the traditional investment routes? Obviously, one of them is that it's a big ticket size item. So the taxing, I heard about taxation also, that it's simplified taxation. You don't have to get into that whole double taxation things, taking an offset in one country and so on and so forth.
Yeah.
Some countries like UAE would be definitely more, I would say,
Advantages.
beneficial because they just completely don't have to pay
Correct.
anything in India. But like, for general audience who is from US or Australia or even UAE. Let's maybe keep UAE and non-UAE audience because I know the advantages would be very different. And then some advantages could be like ease, don't need an NRE, NRO account and all that. So I'm trying to understand if somebody like myself or anyone who is watching this, what are the key advantages that they should be taking when compared to, let's say, the traditional investment route? Because 150,000 is a big amount, right? They can, let's say, put in something else also. So what is propelling NRIs
Yeah.
towards this route?
Yeah. So a couple of points out here. So traditionally, when Gift City was not available, traditionally the most preferred route to invest into India used to be Mauritius. Okay. Now, if you come through Mauritius, the regulations were slightly stringent from the Indian regulator perspective. Basically, what the regulator said that if you are creating or a global fund which is going to invest money eventually into India, uh, they kind of put a restriction for the NRI investments to not cross the 49% limit of the overall size of the fund. So there was a minimum
Hmm.
or a maximum 49% limit for NRI investors. Now, if there is a Mauritius fund, let's say $100 million in size, and the moment NRI investment actually crosses 49%, I cannot take any further money from NRIs. It kind of pauses over there, right?
Hmm.
So which means that if the vehicle is good and everything is fine and people want to invest, but there is no way to invest because most of the funds, the limit used to get hit very, very fast. So,
Hmm.
people like us, actually, I had a fund which I'm now winding up. We
Yeah.
couldn't grow it. We couldn't scale it up to, a bigger amount, right? Some of the
Hmm.
other issues in Mauritius kind of structures was obviously the local regulations. Sometimes there are restrictions on the FATF. So a lot of things, were happening on
Hmm.
that side. Apart from the fact that operationally it is far more tedious in terms of account opening, account closing. Some of the other compliances what we need to do out there. The operation cost also is like is almost double of Gift City. Let me put this way. So
Hmm.
if I'm charging 10
Okay.
basis point as OPEX, it used to be like 25 basis points. So that's a 15 basis point leakage on
Hmm.
the overall return, right? Now, Now,
Right.
when you come to Gift City, some of the things which we really liked and appreciated was one, uh, to promote this vehicle, the regulator has said that there will be no limit for NRI investors. Now I can create a fund which is 100% dedicated to all kinds of investors, whether they are foreign
Mm,
investors, FIIs, NRIs, no limit, right? So the fund
mm,
can, I mean, you investors will have access to the fund, and we can grow the fund. We can create a large scale. So that was one very big, that headache item for us, which is kind of
right.
sorted out. Now, second thing, most NRIs always have on their mind is, if is basically giving your PAN card and your Aadhaar card when you're making your investments into India. Like if you're putting your money through the NRE NRO account, then obviously the government has access to your through the PAN card and Aadhaar card. They can trace you, your income. I mean, at least that is one fear
Mm,
which I have generally heard from NRIs. Now when you come into the gift city, you are not mandated to submit your PAN card and Aadhaar card. To that extent,
correct.
there is that, what do you say, confidentiality of your personal information. So that is something which is again something which NRIs have appreciated about the vehicle. Third part is the taxation we spoke about, right? Now, like you rightly said, let's keep the UAE aside, or let's say the GCC countries, because they don't have
Mm,
any capital gains in the home country. But so to
correct.
that extent, for anybody who's outside of the Gulf countries, there is a long-term, short-term capital gains. Different countries have different brackets of tax, right? Now, in Gift City, there are two types of funds you can create, and I'm just trying to make it little simple and
Right.
taking reference of category three, which is easy to understand. Now, as a fund manager, I can create two kinds of AIFs. One I can create, which is a fund directly managed out of Gift City, which means the fund is domiciled in Gift. It is getting managed. The portfolio is getting created. Stocks are being bought and sold in the Gift City, right? So it's a fund which is directly domiciled and managed in Gift City. Now, as per regulation in category three, if there are activities in terms of buying and selling of stocks, then the fund is liable to pay the tax. Okay. Now, if a stock is sold less than 12 months, there is a short-term capital gain of 25%. And if there is a long-term gain, which is stock sold after 1 year, the taxation is about 14.5%, somewhere there about total tax,
Mm,
including surcharge, etc. Right. Now, this
right.
is deducted at the fund level.
Mm,
Okay, so when you redeem the money, all taxes are paid. All your Indian compliances are fulfilled, and you get your post-tax
correct.
redemption back in your home country. Now, what NRIs will have to do is they have to. Most of the countries we have the DTAA, the double
Correct.
taxation agreement. Now, if let's say it's Australia, while you are filing your returns, you will get your capital gain statement out here anyways. So if in India you have paid 20% capital gains, and in Australia, let's say the capital gain is 30%, then to that extent you just have to pay the differential of
Mm,
10%, right? In case of US, we have to supply an extra document which is called the K1 certificate, which also helps them take the rebate to the extent of all the Indian taxes which are paid. So US is just one additional document
mm,
which we have to give. But at least from the India compliance perspective, let's say if you were an NRE, NRO, you would have to do your compliances out here, TDS deductions, and then you have to file a return here, file a return there. So that way it's slightly more
yeah.
tedious. Here, the Indian part is taken care of. You have to take care of your home country part. So this is in case of products which are directly managed, but tax is there. Okay. Now come to the second part,
Mm,
I think a beautiful thing which is being done by the regulator is you create a fund which is like a fund of fund or a feeder fund, which is underlying investing into Indian mutual funds. Right
mhm,
now, what they're saying is that if you create a AIF which is feeding into Indian mutual funds, in event of a redemption, there is no long-term, short-term liable at the
mm,
AIF level. Now, what is
mm,
happening is I buy, let's say, X fund at 10 rupee NAV. I sell it at 12 rupee NAV. The entire 12 rupee is given back to Gift City AIF. Gift City, in case of redemption, will give exactly pari passu back to the NRI investor, right? So there's no tax at
yeah.
the Indian level. It's a complete pass through. right? So you
Right.
take your gains. Now, if you're in UK, there is a 40% gain tax. You pay your 40%. In US, it is 30, whatever, whichever country, home country
Mhm.
tax, which is where the UAE citizens actually benefit, or the NRIs based out of there, is because there's no tax here and there's no
Yeah.
tax there.
Yeah.
So practically your gross return is equal to your net return, right? So
You're
you save
becoming
on
more
that,
rich.
you become more rich, right? So, so now many managers are actually launching these fund of funds, which are making a lot of sense from tax compliance perspective, and people are really liking it. So I think incrementally, I will see. I think people will launch more of fund of funds than actually direct funds, which are positioned there. So these are some
Right.
of the benefits, and then again. um you know what else yeah, I think opening an account and all that stuff is fairly easy. So operationally it is easy. I
Mhm.
spoke about cost. The cost is like I said, it's almost 40 to 50% lower. It may be an insignificant cost. 15 basis point may not be a very
Mm.
large amount, but still it is lower, right? See, when you're investing,
Correct.
every basis point is your money, right? So whatever you
Yeah.
can, rupee saved is rupee earned.
Correct. And I think the currency conversion as well risks, right? Because I feel that the higher the amount, the higher is the risk of currency conversion. I'm assuming that people would lose money in currency conversion as well. Because
Yeah,
here, if let's
yeah,
say you
yeah.
are,
Yes, yes, you are right. You are right. So there is always a risk for global investors investing into India or emerging markets,
yeah,
which is on the currency side, right? Now, for several years, we had a very stable currency. We were broadly between 73, 75 rupee to dollar. Now,
mm,
for obvious reasons, what's happening globally, and the dollar is getting very, very strong, and therefore it's not that India has depreciated, but globally all currencies have depreciated against the dollar, right?
correct.
Now,
Mm,
obviously, if you invest in India, let's say if you would have invested at 80 rupees and it becomes 87, to the extent of almost 8%, 7, 8%, you have lost on only on the exchange, on the currency exchange.
yeah,
So what we always tell to our friends, investors from out of India, is that always, I mean, obviously, if you're investing, you're coming for 5 year, 10 year kind of a window. Uh, Always bake in a 1 to 2% kind of a annual depreciation on account of currency. So, for example, if you're
mm,
coming for 5 years, for example, hypothetically, you make let's say 13% on that. On 5 year, you lose 1.5% every year. So therefore, your net return is, let's say, 11.5%. So 11.5% or 11% or even 10% in dollar terms, I think is pretty okay with
mm,
investors who are kind of tracking returns in dollar terms, right? I
correct.
think, I believe that anything over 9% dollar terms, post tax and all the stuff, I think it's pretty good, right? So,
It's
but yeah,
good
this is,
actually.
yeah, yeah, yeah.
Yeah,
And of course, this is something broader we are talking about, but yeah, I think, India 20, 30 years back in India, 10 years back is very, very different. Earlier
of
the
course.
depreciation used to be more like 4, 5% a year. Now we are talking about 1.5% every year. So to that extent,
Mm,
the macro side of India looks promising, and we have a $650 billion reserve now.
mm,
Right, we in 1991, when the reforms happened by Mr. Manmohan Singh, we were actually going outside to borrow dollars by
mm,
placing gold. Now we have gold also, we have dollars. This is some, in the recent past, in the
yeah,
last 6 months, is the geopolitical developments, because of which,
mm,
there are a lot of uncertainties, and therefore, all these currencies
yeah,
are getting devalued. Now, I don't know how it will play out in the next 6 months, 1 year. One will wait and watch. But
yeah.
I would still say that account for 1.5 to 2% depreciation, and then see your post-tax return. I think India has the potential to still give double-digit post-currency exchange.
Absolutely. No, I think, I mean, there is absolutely, I myself invest in India. So I think, but I
Yeah.
think you have touched upon a very good point. So I have also noticed. So, for example, if somebody from outside has to invest in India, there is a lot of paperwork, first of all, opening up of NRE account, NRO account. Then, if let's say you're in stock, PIS, non-PIS accounts, there is a lot of things on KYC which is done. And then at the time of redeeming as well, as you rightly said, you have to pay TDS. if the amount is bigger, sometimes the TDS can be stuck for years also. I've
Yes.
heard people who have given
Yes.
me queries that my
Yes.
TDS of anything more than I think 3 or 4 lakhs, there is always this fear that your TDS will get stuck, you will get queries from the income tax officer. So it's obviously a hassle, definitely.
Absolutely.
Uh,
Absolutely.
right? I mean, and it's your money only. And then
Absolutely.
you have to take the offset back in your country of residence. You have to show that paperwork. You have to show that, hey, I filed the ITR. So that I think there is a lot of streamlining of the process
Right.
while your tax benefits may not come down drastically if, let's say, you
True.
are not residing in UAE, but a lot of this administrative task and currency conversion risks and opening up of different bank accounts and then getting your profits, let's say if I'm getting the profits in Indian currency, then by the time I get in my NRE account, there are conversion
Conversion
slippages.
risk. Yeah. Yeah.
Right. So I think a lot of that, I'm assuming, is the benefit for people who are outside of
Absolutely.
UAE or GCC. But for GCC, of course, it's, I would say, a gold mine, I would say, because you're
Yeah.
not even
Yeah.
paying any
No doubt.
taxes,
No
neither.
doubt. No doubt
Yeah.
about it. No doubt about it. So having said so, I think it's a great opportunity for Indians outside of India. The country is offering great wealth creation opportunity now. What I've seen in my past 15, 20 years of interacting with a lot of NRI investors is that if they have $100, let's say, maybe one third of that would be in their residing in their NRE and NRO accounts. So generally, the Indian investments happen through the NRE NRO, and the two-third amount which is back home in dollars is then not coming into India, but it is going everywhere outside of India, right?
Correct.
So now with this vehicle in place and with all the flexibilities and convenience, I think it's a great opportunity for Indian managers to actually take a allocation out of the dollar money which is not coming into India, right?
Mhm.
So, and they can also invest a larger amount, which otherwise because of NRE, NRO, they wouldn't be doing it, right? So
Correct.
it's a very big opportunity, honestly.
Right. So can you only invest in, let's say, Indian stocks or the global stock like US or Australia stocks? Are different stock exchanges available? And can you only, because one of the key questions I keep hearing from people is that can investors also invest in Indian currency, like the INR denominated products through Gift City, or is it
No, no.
only for US? Okay.
No, no, no. So this generally for inbound investments is for Indian asset classes. You want to
Mhm.
buy Indian stocks, or you want to buy Indian mutual funds or AIFs, or open a bank account. You can do all, or you want to buy, let's say at some stage, a private credit fund investing into India. So anything to invest in India, whichever asset class it may be, that's the only route, right? At this stage, at least in Gift City, we don't have. Because if you want to invest in US, you will go to the US directly, right? If you want to invest in UK, you
Mm,
go to UK directly. To come to India,
correct.
you can come through GIFT because of that dollar access, right?
Correct.
Now, we could have international funds in India, but that is for Indians to invest outside,
Mm-hmm.
right? I mean,
How
let's
does that
say
work? Okay.
in the sense that let's say I want to invest a crore of rupees in a Nasdaq fund, right?
Okay.
Now, in INR, I don't have any option to invest in a Nasdaq fund. So if
Mm.
there is a fund which is residing in Gift City, which is investing into Nasdaq, I can move my INR into dollars in the Gift City, invest in the Nasdaq fund. So it is for Indians who want to invest out of India. There are these options which are available to go global. For outside India, Indians wanting to come into India, the Gift City is the access. For all other geographies, they can use other routes through whether it is through Singapore or USAIDs or go to US directly, right? Why will you come into Gift City if you're outside of
Mm.
India, right?
Correct. So, I mean, let's assume if somebody wants to invest in Gift City or AIX, What's the starting point? Do they need to reach out to, like, because I'm assuming your organization, Motilal Oswal, also have a strong presence in the investment space. Like, what are the key steps that they need to go through? Do they need to open some special accounts, or their foreign bank accounts are enough? What kind of documentation is needed? And like, if you can explain briefly, like the process, what happens in
Yeah.
your organization and in general.
Yes. Yes. No, so ideally, the process is very simple. Basically, we have our administrators in Gift City. They are called, so the administrators are called Dovetail. They manage our investors out there. What you need to do obviously is, let's say when you've decided that you want to put in a XYZ AIF or a XYZ fund, then the starting point is to first furnish your KYC document. So your local identity proof, address proof, some of these documents, they are sent to the administrator. The administrator verifies it. They do the global checks, all that stuff to see if there are any issues globally. And they give a clearance that, okay, this particular identity is okay to go. Once they give a okay to go, we managers will get the proper application form filled. So you need to do the application filling process, and everything is happening through email. So it's all kind of digitally. We are not completely online right now. It's happening over email. So first your KYC cleared, then application cleared, then the clearance is given for funding. You do a fund transfer through Swift. Once we cite the fund, we allot the unit. So it is as easy as that. Now, obviously, for an investor who has no clue how to reach to the administrator, which administrator, all this stuff, ideally it's better that they reach out to advisors or distributors, and there are plenty available in, I'm sure, in Australia or wherever, Dubai and all that stuff. So consult your distributors. They will do this operational process to help you open the account. Usually it takes 2 or 3 days time to open the account, maybe 6, 7 days time for the whole fund transfer thing to happen, and that's about it.
Right.
As
So
easy
these
as that.
Indian stocks and options are priced in USD. Like, for example, I'm trying to understand
Yes,
if the
yes,
current.
yes, yes.
Okay.
Everything is in USD. There's nothing to do with that.
Everything is
NAV is in
okay.
USD, redemption, everything is USD.
Okay. So we trade in Indian stocks,
Yes.
not in INR, but in USD.
So
Okay.
money comes in dollars, then the gift city will remit money into India. So there is where the first level of conversion happens. Then when the redemption happens, then the rupee is converted back into dollars because the remittance will happen from the local brokers to the gift city. And then again, it is converted to dollars. So the exchange risk is when you are transferring in dollars getting converted into rupee when getting invested, then
I
getting
see.
out of India into rupee into back into dollar. So in
Okay.
those two legs is where the currency risk comes in.
Okay, but the currency risk are not when you are converting, let's say, a stock, Indian stock is traded in USD, and then, at the time of redemption,
No,
again,
no.
it has to be converted back.
Yeah, so stocks are always trading in INR, right? The
Okay.
Indian markets, Indian stocks are trading in INR, right?
Okay.
So whenever we are remitting money, let's say I get a $100,000 check, I have to remit the 100,000 into India, into Indian markets, right? So there is where the exchange will happen, dollar into rupee. Then when I sell an Indian stock, exchange will give me rupee, I will convert rupee back into dollar and then give it back to the investor. So that is the time the
Okay.
actual realized FX gain loss will come into play. In the meantime, your regular NAVs will have a notional impact of foreign exchange. Let's say I'm like I invested 6 months back. DX, now your dollar was, let's say, 83. Today I'm still invested. It is 87. So to that extent, my NAV has dipped. But after 6 months, let's say 85 is back to 84. So again, you will get the markup, right? So till the time you actually sell, you have not realized any forex gain loss. In the interim, it is only
Correct.
the paper loss, paper gain.
Correct. Correct.
Yeah.
And when somebody has redeemed and taken their profit back into their foreign account, and let's assume they are residing in the US, for example. For them, this is the foreign income, right? So traditionally, people have to show some evidence or something if they have to claim offset. Do you give any certificate? People give any certificate, or how
Yeah,
does
yeah. We give
how
annual
does it?
accounts. We give at the end, we
Okay.
can give a complete disclosure on all the taxes paid at the fund level. And when you're filing your return, you can use the P&L statement or the capital gain statement to take the set of respective country.
Right. And I'm quite curious to know, and I think you rightly said, let's just keep the past 2 months aside because I know market is undergoing a correction right now, so it's not the best time to ask this question. But
Yeah.
let's say from a broader standpoint, how do you see the Indian markets for long-term wealth creation? I know you touched upon it, but what is your projection for next 5 years, 10 years? I'm assuming somebody, if is parking this big amount, would be here for a long run, right? Not for the
Yes.
short-term gains.
Yeah. So, Parul, you've also been in India, of course, now you're in Australia, but you've seen a large part of how India has transitioned from
Yeah,
fragile five economies to now we are in the top five economies, right? A lot has changed over the last 10 years, 12 years in terms of
yeah.
structural reforms which have been done by the government to strengthen the economy and to take the economy now over 10 years from 10th largest economy, we are fifth largest economy at the current growth rates of 10-11% nominal growth for the country, GDP growth, we should be like the third largest economy maybe by 2029, 2030, right? Which means we should be anywhere between $6-7 trillion, depending how the growth rates go. But I'm giving a very conservative outlook. People
Mm,
talk about much a better picture. But very
mm,
conservatively also, we certainly in next 2 years we are becoming third largest. But in absolute size, maybe we might be anywhere between 6 and 7 trillion in the next 5 years. And in next 10 years, we
mm,
should be more like a $10 trillion economy, right? It's just compounding of, let's say, 10%. So 10%, if you do 72 divided 7 point, every 7 years, we are doubling our economy, right? So
mm,
by 2032, we are currently four, we become eight, right?
mm,
And then 2032 go to 42. Then we are a $16 trillion economy. So those are the projections which are made,
mm.
right? So as long as this double-digit nominal growth, the wheel is kind of rolling, there is growth. There is growth,
Correct.
there is opportunity. There is opportunity, the businesses are thriving, the per capita income is growing, there is consumption boom, there is manufacturing boom, and the companies which are prevalent in India, those companies benefit from all this rising growth, rising per capita, blah, 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 right?
Mm,
And that is what reflects in their profits and that is what reflects in their prices, which is what has been
correct.
happening in India for the last 4-5 years and which is what is likely to happen in the next. I don't say that India is a 5 year, 10 year opportunity. Usually I say this is a 25-year minimum opportunity, right?
Mm,
25-year opportunity, but you're playing small parts for next five
small
years, then
part.
next 5 years, then next 5 years. It's like a,
Correct.
yeah, it's a long game test match kind of a stuff,
Correct.
right? Now, the good thing is, of course, Indian companies have done very well in the last 4 years. And as they did very well, the markets did very, very well. Their prices went up, and somewhere down the line, the prices went ahead of the fundamentals. And therefore, we
Mm,
became little expensive in terms of the valuations. I mean, a company it was trading at 20p became 50, 60, 70p.
mm.
So to that extent, for the reasons could be any, but we were sitting on higher valuations, and
Yeah.
because of global uncertainty, more because of Trump and sanctions and tariffs and all this noise which is going on, uh, the markets kind of
Crashed a bit.
chose this opportunity to correct the stocks. Now,
Correct.
as investors, we always say buy low, sell high, right? So you're getting same India, same businesses, but down 20%, 25, 30% business prices. It's just creating a good window for those who want to allocate in India and participate
Correct.
in a very strong compounding story to use this window to invest for a very long drawn wealth creation journey what we feel is going to play out. Now I can go into some small specifics like what could we be let's say 5 year down the line or 10 year down the line. In very simple terms, there is a nice Warren Buffett indicator what we call as market cap to GDP, right? So what is your total market cap of all the listed companies, and you divide it by your GDP size? Usually, let's say for the developed markets like US, this is more like 180% or 200%. Some of the other markets, smaller markets though, maybe not sure about the names, but maybe Taiwan or all these some 3 or 4 smaller
Mm,
markets. This goes well into 220, 230, 240. Means your market cap is 2x of your
mm,
GDP. Now, our
mm,
market cap at peak went to 150%. So it was
mm,
getting little kind of stretched up.
mm.
Today, I think it is more like 110%. All right. Now, even if I take conservatively 100% market cap to GDP. So today we are a 4 trillion economy, 4 trillion of market cap. Like I said that in 5 years, 2030, we are 7 trillion economy. So the market cap should be 7 trillion. That means 4 trillion to 7 trillion, 3 trillion is going to get added to the market cap, which is probably a return of 12-13% pre-tax basis for the next 5 years. I'm giving you a very conservative estimate. It doesn't happen like this. Generally, either it will be like 150, 120, or maybe 90 only, right? But let's go very simplistically. Just pull this data. I mean, like 20 years, if we become like a 20 trillion economy, so 4 trillion market cap goes to 20 trillion, you are a four bagger. Right. So the runway to growth is very long. The structural reforms are in place. We have a stable government. We have a huge forex reserves now. We are at least our inflationary pressures have come off. We are in the comfort band of 4 to 6%. We have seen first round of interest rate cuts. So see, there are three things we have to see: macro, micro, and liquidity for markets. So macro, which is your GDP, interest rate, inflation, and dollars or reserves. These four things are stable for India. Micros is basically the profit growth of the companies, which has become slow in last 1 year because of the high base, right? So earnings growth is very important, or the profit growth is very important, because if the profit doesn't grow, the market cap will not grow. Obviously, the prices will not grow, right? But we have to track the earnings growth, which for the last 3 years has been very robust. 1 year has been a soft year, and we are hoping that next 3-5 years we will still be in double digits, let's say 13 to 15%. So that should be the compounding for the stocks. And third is liquidity. That means we need buyers and sellers in the market to drive the markets up. Now in liquidity, interestingly, what has happened in India is that for a very, very long, and again, you were here, so I'm sure you would be knowing that our markets were driven by foreigners, right?
Right.
Now Indians used to invest after the foreigners used to come and sell after they were gone. So our optimism in our markets used to come from what the foreigners used to do. In the last 5 years, that trend has changed. While in the last 5 years, the foreigners have been continuously selling, we have been continuously buying. So, today, number of mutual fund investors into equities has doubled from 2 crores to 5 crores. Number of demat account holders have gone up like 4x from 2 crores to 18 crores. Right. So there is a risk-taking appetite which has come in Indian investors, and still the allocation or the penetration is 5%. Let's say US it is 40%, the equity penetration is only 5%. So Indians, and we are 140 crore people, right? These people decide to put even 1,000 rupee every month. Imagine the kind of money which can actually flow in, and you combine it with the global liquidity whenever it comes. Whenever there is a certainty around US, I'm sure the FIs will come back. So liquidity will be good. That means demand for Indian companies will be high, backed by strong fundamentals of the companies, backed by strong fundamentals of the country. I think this all put together, if you zoom out and see that if you sleep today and you wake up after 5, 10, 15 years, we would be sitting on very different numbers, right? So one has to believe that yes, this can happen, this will happen, and then you make your allocation. If you have $100, you want to put 10 rupee, 20, 30, 40 rupees into India, you make your allocation, and then just stay put, right? These ups and downs will be there, corrections will be there, but be a long-term investor. I think a lot of money to be made. Yeah. Sorry for the long answer.
No. I think this is very interesting, and I have few follow-up questions. So, if somebody has, because a lot of Indians, even though they are NRIs, they must be having uh, income, not income, but maybe income also, or savings, personal savings back in India as well. So they can use that as well. Not, they don't necessarily have to transfer money from, let's say, US or Australia. They can still use
you can
their
transfer
savings.
from your NRE account. From NRE, you can transfer. From your FCNR account, you can transfer into GIFT City.
Okay.
You can. Yes.
Okay, you can.
Yes.
And
yes.
I feel at
not
the
from
moment,
NRO, but NRE and FCNR.
Okay, NRE and FCNR. Okay, fine. And at the moment, is it reserved to certain kind of AMCs, or because if I look at traditional demat account or mutual funds, I mean there is a huge gamut of AMCs which is present. So in GIFT City, what's happening? Is it only reserved right now to certain kind of AMCs, or it's open for everyone?
It's open for everyone. Slowly, steadily, many AMCs are taking licenses. I think as we speak, We are there, HDFC is there, Nippon is there. I think there are 6, 7 AMCs who
Right.
are already there, who have launched their products,
Right.
and they are raising funds. So I think over time,
Right.
over next couple of years, many more AMCs will come in. See, the idea is,
Right.
how can you get access? I can launch a fund in GIFT, but I need to have understanding of where do I get money from. Like when
Correct.
we launched, we had a relatively good presence in the Gulf countries, right? So
Mm.
we had our own distribution over there. So I had some access to global capital. So I could launch a
Mm.
fund, go to them and get capital out here. But
Right.
if I don't have any access, let's say I got access to you, I'm talking to you in Australia, and you can create awareness out there. So one will come over there in large numbers only when the access is available, the distribution
Correct.
access, the investor access. So it's
Correct.
going to be slow, steady, but the larger players are definitely
Definitely.
they are already there.
Right.
So you
And
can
in
diversify.
future,
You can diversify
okay.
amongst many manufacturers, many products, many options are available.
Right. So currently it's only limited to equities, I believe, right? In future, do we have other instruments like real estate
I We
or
have real estate. We have real.
okay.
So let's say I don't know. I've not seen other manufacturers what they're doing, but in our case, when we have a separate unit which is the private equity unit, private equity real
Mhm.
estate. So we just closed a fund where we raised about $100 million from Gift City
Mm.
into our real estate fund. We will launch a private equity fund very soon. Also, will be available on Gift City for investors to come and participate in the private equity space. So
Mm.
I am sure there will be other guys also who would be doing it. I'm not aware of the names right now,
Right.
but if one does a search, there are opportunities available for all asset classes.
Right. So that's mainly like REITs, for example, real estate investment
Not
trust, right?
REITs.
Similar.
REITs, I'm
No.
not sure whether it is coming. I think REITs you can still buy through
Okay.
the exchange. So there is an exchange out there.
Okay.
So you can buy through
Okay.
exchange. This is like a proper real estate PE fund. I mean, where you give
Okay.
the money to the fund manager. It's like a AIF Cat
Right.
2 real estate fund.
Okay.
Uh, the money gets invested into real estate companies, not equity, but in the
Okay.
form of debt,
Okay.
right? And whatever interest which comes from there is then passed on back to the investors. So you can participate in the Indian real estate sector, in the Indian private
Mm.
capital space, in the listed space. And I think there are many more ideas we have in our mind. You
Mm.
know, like one thing which we are thinking of is, let's say, um, the long short funds. Now, in long short funds,
Okay.
there is a part of the portfolio which is where we use derivatives to protect your portfolio. Now, in
Mm.
India, if you do a long short fund, the derivative component is taxed at full rate. I mean, full 40%,
Mm.
right? But in a gift city, business tax is zero. So I can
Mm.
save like 4-5% straight away on the derivative part, and the same fund, the returns in the gift city versus the return in India will be dramatically different in favor of the gift city.
Mm.
So there are many ideas because
Correct.
of the tax holiday which is available for the next 10 years. There are
Mm.
very nice ideas which are available. So look out for this space, I would say.
Yeah. So currently, like for example, many people would be doing equity investing through brokerage accounts, right? Or they
Right.
demat accounts. So is this product like proprietary? Like for example, if somebody wants to invest in Motilal Oswal, they have to come to you, or in future, or maybe it's happening right now as well. It's happening through brokerage accounts as well, the Gift City
No,
product.
this is direct to the asset manager. It's a direct relationship
Okay.
between investor and
Okay.
an asset management company. There is an intermediation in between. I mean,
Okay.
assuming hypothetically, let's say you are an advisor or you are a distributor. So you have
Right.
your investor, you know the manager, you get the arrangement done between the two things. So there's nothing to do with stock market or all that stuff.
Okay.
This is just like buying a mutual fund in Australia. It's just as
Hmm.
simple as that.
Right. And the redemption, I'm assuming, is easy, I believe, right?
Again, it's
So,
a
no.
small step. There's a redemption form, send it across, done deal.
Okay. Because usually redemption can be very challenging, especially
And that's
in
why
HDB.
the AIF is the easy vehicle.
Yeah. Yeah, exactly. And I feel that currently it's still 150,000, which for an average Indian maybe is still a high, even if they are an NRI, it's still a uh, high threshold. But I'm assuming, let's say, if you said at the beginning that if that threshold can be reduced in the future, I'm sure it will open up the doors for many investors.
That there are these global platforms where managers get their products listed. We have got a product listed. I spoke about Crystal as a platform. You can just kind of Google and you will reach that platform. Now that platform is basically gives access to variety of managers all over the world. So our product is listed there. Now the beauty of this platform is that this platform is actually the investor of MOAMC, or Motilal Oswal Asset Management, right? Now the minimum 150,000 is at the platform level. It's an omnibus structure. Now underlying they can take money from the investors in lower denominations. In this case, we have capped at $50,000. So actually you can come into our product using that platform with a 1/3 of the amount, right? Which is $50,000. So maybe offline I'll explain to you. It may be too, it may get a little complicated on this first video. Yeah. Or maybe I can introduce you to those guys and you can do a YouTube with them. They'll explain how it works.
Oh, yeah, definitely. I think because I feel it's such a complex topic, and I mean we can't do justice in such a small time. But I feel that this has really been a very insightful discussion, Mr. Akhil. And I know you're extremely busy, but thank you so much for taking out time. And I'm pretty sure the audience, including myself, we have a lot of questions. But I'll request the audience, if you do have questions, please drop them in the comments. We'll try to cover them in part 2. We can create a sequel of this. But Mr. Akhil, any parting thoughts you have uh, for the NRI viewers, or maybe even for the viewers in general, like even in India, is there some benefit for people in India as well, or is it just for NRIs, which is this product?
No, this benefits. So first of all, thank you, Parul, for the invitation. It's been a pleasure talking to you. One of the most comfortable calls I've had. I think I'm really enjoying doing these calls, explaining people of about the Gift City and creating awareness, because it's a great platform, great vehicle for brothers and sisters who are just like working outside and for and wanting to participate into Indian variety of investment products, but could not because of various limitations. Things are getting better. Things are opening up. I think Gift is a great platform within India. We can understand it better, very cost efficient, and for both Indians as well as outside Indian investors or NRIs. I think NRIs wanting to India can use the Gift. Indians wanting to go outside India, you can use the Gift. So Gift is just in between a layer which gives you a global access, whether it is into India or out of India. So personally, like I'm an Indian, I'm a resident Indian. And I'll give you a small example. Like my daughter will be going abroad for education. She'll be going to US end of this year. So I want to now incrementally lock some money in dollar assets, right? So I will use Gift City kind of a platform to put some part of my money in dollars, so to hedge myself against dollar appreciation, right? So that's how I can use as a resident Indian Gift City platform. Similarly, those who are outside can come into India. Now that is a bigger opportunity because uh, uh, see, if you want to make money in equity, you have a handful of countries where you can make money, right? You have US, you have India, you have China, maybe you have Europe, maybe you have South Africa, 4 or 5 countries where you can understand the country. The judicial system is fairly good. There are great businesses out there. The economic growth stories are good, and only those countries you can make money in equity. So if there are 4 or 5 geographical, and if I have to narrow it down, there are only 3 markets which largely get allocations. The largest allocation goes to US, followed by China, and third, generally it would come into India kind of a vehicle, right? So I think India is changing. It's a great growth story. Have a very long-term outlook, at least like a 10-year plus kind of outlook, 3-year, 5-year. It is like anybody's guess. You may be in money, you may be out of money. So I can't make any guarantees there. But 10, 15, 20 years, I think this country can give huge wealth creation opportunities. And keep some allocation here. As I said, start with a 10%. As you get comfortable, increase it to 20, 30, 40, and rest of the money you diversify wherever you want to diversify. And then people like you, I'm
Absolutely.
sure, doing a lot of work on the awareness. We are all available here. If we can do more calls, videos, products, compliances, platforms,
Obviously.
we are all here to help you guys.
Absolutely. I have two questions before I,
Sure.
I allow you to
Sure.
go. So one is that I think I'm curious to understand because you mentioned you are a resident Indian and your daughter is going to go to the US. So because a lot of my audience is also still from India, even though it's a video dedicated for NRIs, but what is in it for resident Indians? I think I'm very curious to know that aspect.
Yeah. I'll give you a small example, right? So my daughter got admission 4 months back, right? Rupee was
Okay.
83. Now let's say I have to spend $100,000. My budget would have been 83 lakh rupees. Now the rupee has gone down to 87. So in 4 months, my cost has gone up from 83 lakh to 87 lakhs. That means I have lost
Right.
4 lakh rupees. I have to put additional 4 lakh rupees for getting the same
Correct.
product, right? So now if we assume that, like I said, that for outside investors, assume that there is a 1.5-2% depreciation, right? So for Indians, there is a 1.5-2% appreciation. Now,
Hmm.
if I have some expenses which is in dollar terms, then I need to hedge myself for any substantial erosion of the currency value.
Correct.
So some part of my money, let's say if 10% of my money would have been in dollars 3 months back,
Hmm.
I would have gained by 4 lakhs. By having in
Correct.
rupee, I lost by 4
Correct.
lakhs. So some
Correct.
part of your
Correct.
money, if you are, let's say, having to do any significant investment, you want to buy a plot, you want to buy a flat, you want
Hmm.
to do some business, or you want to this education or medical, then it always makes sense to have, for Indians I'm talking about, resident Indian, 20, 30%, 40% allocation outside India, 60, 70%
Hmm.
allocation within India. Now, within
Hmm.
India, there are challenges because we have international funds, but they are subject to a limit, and that limit is kind of capped up.
Right.
So now Gift City is the only platform, and you have a limit of, through Gift City also there is a limit of the LRS limit, the liberalized remittance scheme,
7 lakhs.
which is $2.5 lakh, $250,000 per PAN.
Yeah.
Right. So
Correct.
in a family of four, $1 million is what you can take every year out of India. So वो
Right.
भी capped ही है. It is capped. You can't do anything
Right.
more than that.
Right.
But at least
Right.
for small people like me or the upper middle class people, it's a good enough. Yeah, $1 million is a
Yeah.
lot. For the
Yeah.
rich, it is a different
Absolutely.
issue. So that
No,
is
I
what I
feel
was
like
trying to explain.
yeah, like people, of course, because nowadays everybody is sending their children abroad for studies. So definitely it's a good idea if you start early. And people are doing any which way. People keep money for children education. Why not
Yes.
use a vehicle like this for,
Yeah.
and sometimes people are in India, but they are interested in a real estate market outside India. So you may want to
Yes.
like
Yes.
as you explain, hedge your money against that, and there are no restrictions. I mean, even if you are a resident Indian, you can still park your money and take benefit
Absolutely.
out of it, I
Absolutely.
believe.
Now you imagine
That
we in Motilal Oswal we have a fund called Nasdaq 100 Fund. We
right,
launched this fund back in 2010. So almost
right,
24 years. 24 years. When
right,
we launched the fund, INR Indian rupee used to be 45. Today it is
right,
87. So
right.
without, if US would have given zero return, still this 45 become 87, which is almost what, two times. You would have
Right.
made 2x only on currency depreciation.
Hmm.
So for Indian investors who put money in dollars, you make twin returns. One you make from the underlying asset, one you make from the currency depreciation.
Right.
Right. So actually, Indians putting money outside India, it actually has played out in the past. I don't know how it will play out in the future,
Correct.
but we are developing market, so therefore currency will always be subject to risk of depreciation. So there is no two doubt about that.
Absolutely. No, I think this has been a wonderful session, Mr. Akhil, and I'm sure I think as and when people become more and more aware about it, I'm sure it will not only help them, but I feel it will also boost India's economy also because
Absolutely.
money is coming
Absolutely.
into India. It will lead to more employment uh,
Yes.
and more transparency as well, I
Yes.
believe, because we need to
Yes.
get rid of all these siloed structures that we've been having. So I feel at least in next 10, 20 years. And I'm not a projectionist, so don't quote me on it, but
Yeah.
I feel that this is a long-term product which will stay for at least the next 10, 20, 30 years.
100%. That's what I've been saying. Like, come for like 10 years plus. Right?
Right.
Buffett says invest when you have money, redeem when you need money. So till such
Correct.
time you need money, just stay invested. It could be 20 years, it could be 30 years. Create a
Yeah.
legacy, right? You can pass on money to your generations ahead. So, investors typically, and this is worldwide, not only Indians, before we put money, we start to think about when to take it out. And when we talk about compounding, because wealth is created by compounding.
Correct.
Compounding will
Correct.
always break the moment you break your journey, right?
Mm.
So compounding works only with time. Like, uh, like let's say you have an asset which compounds at 15%. Now you have that asset for 5 years, your money doubles. But if you keep it for 10 years, it goes 4 times, it quadruples,
Mm.
right?
You're
And
right.
you go 15 years, it goes up 8 times, and 20 years, it goes up 16 times. So,
Right.
but you have to just be there.
Right.
Right. So there is
Absolutely.
in between, people kind of time the markets and bullish, bearish, take it out, put it in, and there is this whole compounding journey gets broken up. Difficult to practice, but if done, then you can really become super rich.
Absolutely. And last question, Mr. Akhil, if people or viewers have to, let's say, reach out to Motilal Oswal if they are interested in the product, then I'm assuming I can share the details with the
Yes,
viewers. They
certainly.
can
Look forward. Look forward.